Well, really, when we think about ESG, the first word that jumps to mind is sustainability. And we've always thought about sustainability and the sustainability of the borrowers' businesses that we're lending to. So we're not equity investors, and in some respects that means we're more focused on ESG because we don't share the upside if the business is not doing something sustainable, but we have all of the downside from that risk. So that word sustainability for us is front and centre of any credit underwrite that we do. In private markets, we think there's a particular opportunity in sustainable or ESG investing because our ability to engage with the borrowers is far greater. So what we can do is talk to management, talk about their business, identify risks in that business practice, whether they're environmental, social or governance related, and work with them either through the terms under which we lend or just by direct engagement with them to mitigate those downside risks to the benefit of our investors. Yeah, I think we see that when we talk about stranded asset risks. So the big downside when you think about ESG is that the market around you evolves in a way that you don't expect or you don't predict. And so the coal sector is a really interesting example. Over the last decade, what we've seen is investors raise their standards around what they expect from companies operating in that sector. And what that does is creates a risk that if we have an exposure to that sector and ultimately that comes up to be refinanced, that we're exposed to what other investors think about that risk. And what we're seeing is that other investors see that risk as increasingly difficult to lend against. And so you have the risk that that asset is effectively stranded, and we're reliant on the equity sponsors of that investment to provide the capital to refinance us. And that's quite an uncomfortable position, as you can imagine, for a lender to be in. So when we think about that stranded asset risk in our portfolios, we're really looking 5 and 10 years into the future to see how market standards will evolve and people's views around the risks around particularly environmental risks in their portfolios evolve. Well, I think gas is increasingly coming under scrutiny as the next most sort of carbon intensive sector in the wider economy. So I think that's going to get a lot of focus. Anything that the big focus right now, I think for certainly the institutional investor base, is the net zero by 2050 and people focusing on 2030 as the first sort of port of call. And so we're starting to get questions on our portfolio, certainly around the carbon intensity. And so if you are lending to a company that has a high level of carbon intensity and that's not being reduced and they don't have plans to reduce the carbon intensity of their business model, then I think that's a real risk to focus on. Well, I've talked about the private markets as a place where you can find yield in today's market. And when we talk about private markets, we talk about illiquidity premiums. So that's that excess return that you get over and above a public investment of a similar level of credit risk. So effectively, we target a 2% excess return per annum for investing in private investments versus public. And we think that that's held fairly steady over the medium term, over the last 5 years, say. That's been fairly steady. In 2020, we really pressed pause on that as public markets really sharply sold off. But as they've normalised and really gone through those pre-COVID levels, that liquidity premium has expanded. So we think that's a risk premium that's quite cheap right now relative to, say, credit risk premium and interest rate risk. Yeah, look, there's a broad range of sectors, and that's one of the really interesting things about the private markets is you're not just dealing with the ASX 200, so you're not heavily focused on financials, REITs, infrastructure names. So we have names in our portfolio in the healthcare sector. We have names in consumer discretionaries, consumer staples, all across the wider economy. And so one way that you can get a really diversified set of exposures to corporate Australia is by going into those private markets rather than having to give your money to a bank who then spreads the money out according to where they see value. We can do it directly ourselves, and that's what we like to do.